Good day everyone. In this video, we're going to discuss about debt securities market which covers chapter 5. Let me introduce to you myself. I am Rayhana Dagalangit, the first presenter of the group 1. So this is the table of contents of our topic, which we're going to tackle what are the debt instruments, importance of debt instrument, types of debt instruments, what is a debt security, basic terms of a debt security, and types of debt security, and the comparison of both debt security versus debt instrument, type of bonds, characteristic of bond and bond valuation. Our objectives. After successful completion of this chapter, you should be able to first identify different types of bonds and select the bond or debt security investments that will yield higher value. So let's begin our discussion on debt instrument. What are debt instruments? It is a paper or electronic obligation that enable the issuer to raise funds by promising to repay lender in accordance to terms of the contract. It also provides a way to market participants to easily transfer the ownership of debt obligations from one party to another. And it is a legally enforceable evidence of a financial debt and promise to timely repay the principal and interest. Again, when we say debt instruments or financial obligations that allow the issuer to borrow money from lenders, they can be in the form of paper, documents, or electronic records. These instruments provide a way for market participants to transfer the ownership of debt obligations from one party to another. Debt instruments serve as legally enforceable evidence of a financial debt, and they include terms and conditions that outline the repayment schedule, interest rate, and the other contractual obligations. The issuer of the debt instrument promises to repay the principal amount borrowed and the interest according to the terms specified in the contract. These instruments are commonly used by governments, corporations, and individuals to raise funds for various purposes. Examples of debt instruments include bonds, notes, certificates of deposit, and mortgages. By issuing debt instruments, borrowers can access capital from lenders, while lenders earn interest on their investment. The transferability of debt instruments allow investors to buy and sell them in the secondary market, providing liquidity and flexibility to market participants. So let's proceed to the next presenter, which is Mark Andogan, to continue the discussion.
Thank you for that. Now let's discuss what are the importance of debt instruments and the types. So there are two prominent importance of debt instruments. First and foremost, it makes the repayment of the debt instrument legally enforceable. Why? Because when a demander of funds avail a debt instruments from a supplier, both parties are required to undergo a contract where specific conditions are established and must be met, such as schedule of payments, interest rates, and collaterals. So, in the case of the demander not being able to comply of what is set out in the contract, consequences such as negative credit ratings, lawsuits, and declaration of liquidation or bankruptcy may happen to the demander. Moreover, at this juncture, it is worthy to mention two bills of rights under the 1987 Constitution of the Republic of the Philippines, Article 3. Under Section 19, Excessive fines shall not be imposed, nor cruel, degrading, or inhuman punishment inflicted. In addition, under Section 20, no person shall be imprisoned for debt or non-payment of a poll tax. So, if fine set out by the supplier is proved to be unjust, then it will be dismissed or adjusted by the court, and if cruel, degrading, or inhuman punishment is inflicted, then the supplier will be dealt by the court. An example of this is posing someone who is unable to pay their debt or physically attacking someone for their failure to pay. Moreover, if the demander can't pay his or her debt obligations, she or he will never be imprisoned. Now let's discuss the two types of debt instruments. First up, short-term debt instruments. Obligations both personal and corporate that are paid within 1 year, meaning payment can be made in days, weeks, and months as long as it does not exceed within 1 year. Examples are credit card bills, payday loans, car titles, consumer loans, revolving credit line, treasury bills. Second, long-term debt instruments. Obligation due for payment for over a year through periodic installment payments. Just a clarification, payment can still be made within weeks. It does not necessarily mean that payment should and must be made over a year, but certainly payment can be made more than a year. So examples are mortgage. That is all from our part, sir. Thank you.
Debt securities. What is debt securities? Debt securities are financial instruments that represent a loan made by investor to an entity, such as government, corporation, or financial institution. Those securities have defined terms including amount borrowed, interest rate, and maturity date. They can be both or sold between two parties in the market. Debt securities are commonly refers to a fixed income securities because they provide a fixed stream of income to the investors in the form of regular interest payment. The interest rate on those securities is determined by factors such as creditworthiness and repayment ability for borrowed. If the borrowed is considered to be less risky, the interest rate may be lower, while the highest risk borrowed will have a higher interest rate compensate investor for the additional risk. The market for debt securities is significant with the total value of daily traded securities often exceeding that of trade stock. This is because debt securities are widely used by governments, corporations, and other entities to raise capital. Investors are attracted to debt securities as they offer relatively stable returns and can be important component of a diversified investment portfolio. Here are some examples of debt securities. First is collateralized securities. Those are debt securities that are backed by specific assets, such as loans, lease, or receivables. If the borrower defaults, the assets can be sold to repay the investors. Second is collateralized debt obligations or CDO. Those are the type of collateralized securities that is specifically backed by pool of debt such as loans or bonds. Third is collateralized mortgage obligations or CMO. Those securities are backed by pool of mortgage loans. They are created by dividing the pool into different tranches with varying levels of risk and returns. Fourth is a mortgage-backed securities (MBS) issued by the Government National Mortgage Association or GNMA. Those securities are represent a share is a pool of mortgage loans that are guaranteed by the GNMA, a government agency. and the zero coupon bonds. Those bonds do not pay regular interest payments. Instead, they are sold at discounts to their face value, and the investors receive the full face value at maturity. Those are the few examples of the various types of debt securities available in the market. They provide investors with opportunity to earn income and diversify those investment portfolios.
And now let's proceed to the basic terms of debt security. First is define debt security in basic term. These are financial instruments that represent a loan made by an investor to a borrower. So there are three basic terms that are assigned in debt security. These are national amount, interest rate, maturity, and renewal date. We have national amount. So this is the amount of money the federal government has borrowed to cover the outstanding balance of expenses incurred over time. Second, we have also the interest rate, the percentage amount that you pay for borrowing money or get for lending money for a period of time, usually a year. And the last one is maturity and renewal date. This is the date on which the life of a transaction or financial instrument ends. After it must either be renewed or it cease to exist. So next, we have a different types of debt securities, which are money market debt securities and capital market debt securities. We can define number one, money market debt securities. These have short maturities and the usually less than 1 year. It includes the treasury bills, certificate of deposit, and etc. And the second one, we have capital debt securities. These have a longer maturities and usually more than 1 year. It includes a note, bond, and mortgage, or in short, the non-current liabilities.
Good day, everyone. I am Alifa Putri Abbas. The next is the differences between debt security and debt instrument. Debt security is essentially a financial instrument representing borrowed money that must be repaid, typically with a fixed amount, a maturity date, and an interest rate. It can be bought or sold between parties in the market, and some debt securities may be initially discounted. Example of debt securities include treasury bills, bonds, preferred stock, and commercial paper. On the other hand, a debt instrument is a broader term that encompasses various tools used by entities to raise capital. These instruments can exist in both paper and electronic forms and give market participants the ability to transfer ownership of debt obligations from one party to another. Debt instruments focus on debt capital raised by institutional entities and include a wide range of financial products such as bonds, debentures, or what we call the unsecured loans, leases, certificates, bills of exchange, promissory notes, credit cards, loans, and credit lines.
Hello everyone, Assalamualaikum. Peace be upon to each and every one of you. So I think for this slide, I will be teaching to you what is bond, and of course, the typical example of that instrument of indebtedness of the bond issuer to the holders, of course. So my introduction to each and every one is what is bond, no? Ano nga ba ang bond? What is the main purpose of bond? And why is bond instrument is one of the effective way and an advantage to the creditor, no? So alam naman natin that creditors is usually sila yung nagpapautang at ang debtor naman is sila naman yung mangungutang. So what is the effective way ng bond? So let us say I'm going to give an example. Let us say that an entity has to borrow money. Of course, manghihiram siya ng pera para sa kanyang business. So, yung entity, para makahiram sa kanyang business, kailangan niyang maghanap ng creditor. Oh, eto naman si creditor na magpapautang, wala siyang tiwala na sa halagang 1 million na ipapautang niya, sasabihin na natin si entity probably needing 1 million, no? Etong si creditor na magpapautang, wala siyang tiwala na 1 million mababayaran. Kaya naman, maghahanap si creditor ng bond, no? So what is bond? Anong purpose nitong bond? So ang purpose ng bond is that you will be paying cash sa bond. Kung mangungutang si entity, kailangan niyang maghahanap ng bond holder. So magdi-distribute siya doon ng cash. So by then, if ever man na hindi mababayaran ni entity si creditor, at least may tatakbuhan si creditor. At saan niya kukunin yung babayaran? Kukunin niya syempre kay bonds, which is binayaran ni entity. So one of the effective way of entity is of bond holders is that they will be securing the amount of money na binayaran sa kanya. So if ever man hindi makakapagbayad si entity kay creditor, of course, meron tayong bond. So the creditors will able to run after the cash contributed by the entity to the bond holders. So yun yung purpose niya. At the same time, it is an advantage for those creditor kasi nga talaga namang masisecure na babayaran siya. So ganito ang mangyayari dyan. If ever man na mabuti naman si entity, nagbabayad naman siya, nakapagbayad siya ng liability niya, so nakuha niya yung 1 million, nabayaran niya na yung 1 million, anong purpose ni bonds, no? Meron bang nakuha ba, naka-benefit ba si bonds? Of course, yes. Dahil sa ilalagay na interest ni bonds na kailangan mong bayaran. So, it depends kung ilang interest yung kailangang hingiin ni bonds. Okay, so we will be moving into an example of debt securities have implied level of safety because they ensure that the principal amount is returned maturity date upon the sale of this security. So it is sa madaling salita, bonds usually defined as debt securities. Okay. So I'll be giving an example of type of bonds, at least two. So we have the corporate bonds. And these corporate bonds are bonds issued by corporation to finance operation or expansion. So, sa madaling salita, if ever naman na ang corporation, sabihin na natin, ang corporation ay nangangailangan ng 2 milyon, 2 million amount of cash para mapalago yung corporation, pwede silang mangutang. So, anong bond nga ba ang gagamitin ni corporation? At meron tayong example dyan na mag-fit doon. So, the number one will be the corporate bonds. So, the idea of corporate bonds, guys, is that, let us say that the corporation is needing something to run its corporation. Probably the corporation will be needed such equipment to run, of course. By then, the corporation will find way para magkaroon siya ng pangangailangan. So, sabihin na natin, kailangan ng corporation ng backhoe, no? So, by that, the corporation will find a way para makahiram ng backhoe. Ayun na nga, naghanap si corporation, di ba? Of course. So, nung nakatanggap si corporation, nakahanap siya ng magpapahiram, which is si creditor. Sabi niya, hiramin mo tong backhoe ko na nagkakahalaga ng 1 million. No? So, kung nahiram niya, o sabihin na natin, nahiram niya, no? Nakahiram siya. Pero, sabi nung magpapahiram, since you are corporation, you have to find corporate bonds. At dito papasok si corporate bonds, no? Pagpasok ni corporate bonds, a corporation needs to pay, no? Magbabayad siya ng pera kay corporate bonds as to secure na hindi, kung may mangyaring masama, let us say, that the equipment that the corporation borrows is nasira or sabihin na nating nasunog. O paano niya babayaran ng ganun, di ba? Wala nga siyang amount of money. Diba? At least, nakapag-down payment si corporation or nakabigay ng pera si corporation kay corporate bonds. And by then, maliit na lang ang babayaran niya kasi ibibigay naman ni corporate bonds yung hiniram niya kay creditor. No? So, since si debtor nagbayad kay corporate bonds, nasira ni debtor yung equipment, sabihin na nating nasunog, therefore, the creditor will be able to run after the contribution of the entity or the corporation, should I say. Diba? So yun na yung kukunin niya yung contribution ni debtor, then if ever na may natira pa, at least less na lang yung liability niya at nabayaran siya. Di po ba? So on the other hand, although you still haven't paid your obligation, the creditor still successfully receive money amount from you. So yung natira na lang is yung babayaran niya. And at the same time, the corporate bonds will also issue an interest on the borrower. 'Di ba? Sige, sabi na natin dito, since hinawakan ko yung pera, kailangan ko ng interest. And of course, since may interest, yun nga, babayaran pa yun ng borrower. So ganun yung concept nun. Sa madaling salita, corporate bonds used to hold the amount of money that hold an amount of money so that at the end of the day, if there will be a fraud happening, of course, the creditors will still have an amount of money that he will run after you since you have contributed. And at the same time, there will be an interest, there will be an advantage to corporate bonds since then that you have a contribution money, there will be an interest on it. So for number 2, I think nothing changed. So it's still the same concept as corporate bonds, but the idea is different now because you will be lending money to the government. So if you're going to lend, if you're going to borrow money into government, the government will introduce you to have the government bonds. I mean, not at all, but there's still sometimes that the government has their own trust issues. So for the government to be able to lend you some money, the government requires you to have a government bond. So usually, if you are an entity and you will be borrowing money from the government, you have to find such government bonds to pay, of course. As the government bonds receive the amount of money or the amount of cash, if an entity won't be able to finish the transaction by paying its liability to the government can run after those contribution of money to the government bonds. As the government bonds will still remain, that you will also have still liability. So you have two liabilities from now. You have liability for the government, and you also have liability to government bonds. So definitely, it's still a disadvantage for the debtor if you're going to borrow money from the government. So the other thing here is that you are not just securing your money into the government, because as time goes for the government, and you also have liability to government bonds. So definitely, it's still a disadvantage for the debtor if you're going to borrow money from the government. So the other thing here is that you are not just securing your money into the government, because as time goes by, the government bonds issued interest. So you'll be paying interest to the government bonds. As if the entity will be able to pay its liability to the government, still, the government will return the amount of money that you have contributed to the government bonds. But still, you will be paying, as the money will be returned to the entity, the government bonds will issue interest. So there will be a deduction on that. So the best thing and the best idea for that is, if you're going to lend money to the government, it should be that you will be paying your obligation. So as you pay your obligation, less interest will be deducted to you. But as the time goes by, let us say that you've lately paid your obligation to the government. Still, the government bonds will issue a lot of time, a lot of day, a lot of months. So there will be a huge interest attached to your liability. So by that, the government takes the advantage of receiving the obligation by paying your obligation, and the same time, the government bonds usually have an advantage because the government bonds will receive an interest. So that is the main concept of corporate bonds and government bonds. Usually these types of ideas, or should I say these types of instruments, is to secure that the debtor will be able to pay the obligation. If the obligation is paid, therefore, if the obligation is void, therefore, the amount of money that you've sent, or the amount of money that you've contributed to the bonds usually will return unto the entity. But yet again, there are still times that the bonds usually puts interest on it, and at the same time, the creditor will be able to secure that the debtor will pay after all. So I think that's all the main concept that of corporate bonds and the government bonds. Thank you.
So let's proceed the other types of bonds. Third, municipal bonds. Municipal bonds means these are bonds issued by local governments or their agencies. The purpose is to raise funds for specific projects such as building infrastructure, school, or other public facilities. The interest earned on municipal bonds is often exempt from federal and sometimes state income taxes. So, for instance, the city sold $50 million worth of municipal bonds. The money raised will be used to build a new public library. The investor who buy these bonds will receive regular interest payments, and their earnings are not subject to income tax. Fourth, mortgage bonds. These bonds are backed by a pool of mortgages on real estate properties. It shows the payment on these bonds or the interest and principal came from the monthly, quarterly, semi-annual mortgage payments made by the homeowners. The bonds are secured by the underlying real estate properties. So, for example, a company pulled a group of mortgage on homes. So, the company sold 100 million worth of mortgage bonds which are backed by these mortgages. The interest and principal payments made by the homeowners are used to pay the investor who owns these bonds. So fifth is asset-backed securities or asset-backed bonds. These are financial securities that are backed by a pool of assets such as loans, leases, credit card debts, loyalties, or receivables. The cash flow generated by this underlying asset are used to make payment to the investor who hold the ABS. ABS or asset-backed securities are created to provide liquidity and diversification for the original asset holders. For instance, a company pulled together various types of debt such as personal loans and credit card debt. The company created an ABS that is composed of these debts. So, the cash flow generated by the debt is used to make payment to the investors who own the ABS. So number 6 is collateralized debt obligation or CDO. CDO means are structured financial products that pull together various cash generating assets such as loans, bonds, or other debt instruments. So these pooled assets are then divided into different risk tranches, with the senior tranches being generally safer because they have priority in receiving payments from the collateral in the event of default. It shows that investor can then buy the different tranches of the CDO depending on their risk, appetite, and investment. For instance, a bank pulled together various types of debt um, such as personal loans, auto loans, and credit card debt. So the bank created a CDO that is composed of this debt. So the CDO is then divided into different risk tranches, where the senior tranches are safer because they are the first to receive payment in the event of a default. Investor investor can buy different tranches of the CDO
Alhamdulillah,
depending
that's
on the
all
risk
for
appetite.
the group 1.
For
Thank you all
enlightenment,
for taking
these
the
types
time
of
to view
bonds
this video
are designed to
presentation.
provide
I
funding
hope
for
we were
various
able to
purposes
provide
such
you
as
with
government
valuable
project,
insights
real
and a
estate, and
clearer
other
understanding of the
asset-backed
topic.
investment
We
by
appreciate your
pooling and
attention and
repackaging.
time.
I hope
Thank
this
you
simple
once again and
example
have a
helped
great day.
explain the different types of bonds.
Good day, everyone. My name is Devon, and I'll be continuing the report. So, here are the characteristics of bonds: the coupon rate, maturity date, current or market price. Coupon rate. This is the interest that the bond issuer pays the bondholder. It's usually a fixed percentage of the face value. This payment could be semi-annual, quarterly, or annually depending on bond terms. Next will be the maturity date. The maturity date is the date when the bond issuer has to pay back the full face value of the bond to the bondholder. Bonds can have maturity dates ranging from 1 year to 30 years or more. When the bond reaches its maturity, the bond issuer has to repay the full face value to the bondholder. The last one would be the current or market price. It is the price at which bond is currently trading in the bond market. This price can be different from bond's original face value. The market price of bond goes up and down based on factors like interest rates, the bond issuer creditworthiness, and time remaining to maturity. For example, if interest rates go down, the market price of existing bonds will go up since the new bond will be issued at the lower rates. In summary, the coupon rate is the interest the bond pays. The maturity date is when the bond has to be repaid, and the current or market price is the price the bond is trading at in the market currently. These are some of the key characteristics that investors look at when evaluating and buying bonds. Now let us proceed to bond valuation. It is the process of determining the fair price or value of a bond based on its expected future cash flow and other factors. The key components of bond valuation are face value, coupon rate, maturity date, and yield to maturity date. This calculation determines the fair market price of the bond based on its expected future cash flow and prevailing interest rate environment. The key point is that bond valuation focuses on the present value of bond future cash flow, discounted at the appropriate rate to arrive at its current worth or market price.
Good day, everyone. I am Omar Iabit, your reporter. So let us proceed to the approach and bond valuation. Letter A po is traditional approach. This approach is the most common method of bond valuation. So here every cash flow generated by the bond, which includes periodic coupon payments and principal repayments at majority. It is discounted back to the present using the same interest rate or discount rate. So for example, let's say we have a bond that pays a 50 pesos coupon semi-annually and has a face value of 1,000. So which will be repaid after 5 years. So if the discount rate is 5%, the present value of the bond would be calculated by discounting each of the 50 payments and the 1,000 payment at the 5% rate. So dito naman sa letter B is it is a arbitrage of revaluation. This approach also is a bit more complex. Here each cash flow is viewed as a separate zero coupon bond and is discounted at its own unique rate. So this approach also is often used for more complex or risky bonds where the risk and therefore the discount rate may change over time. So for example is let's consider a bond with the same terms as above, but this time the discount rate for the first year is 4%. For the second year it's 5%, and for the remaining years it's 6%. So each cash flow would be discounted at its corresponding rate. So let us proceed to the valuation of bonds with embedded options. So these are two, which is the latest model, and the Monte Carlo simulation model. So latest model is a model commonly used for callable and putable bonds. So these are bonds that can be either bought back by the issuers or sold back to the issuers by the bondholders. So at specified times for specified prices. So the latest model creates a tree of possible interest rate paths and calculates the value of the bond at each node of the fray. The second one is the Monte Carlo simulations model. So this model is used for more complex securities like mortgage-backed or asset-backed securities. So it uses random sampling and statistical modeling to estimate the probability of different outcomes. So, for example, it can be used to estimate the likelihood of homeowners prepaying their mortgages, which would affect the value of a mortgage-backed security. So that's all for my part. So thank you.
Alhamdulillah, that's all for the Group 1 report. Thank you all for taking the time to view this video presentation. I hope we were able to provide you with valuable insights and a clear understanding of the topic. We appreciate your attention and time. Thank you once again and have a great day.